And then I decided that I've got to go out and share this information. So I became an independent contractor and literally traveled the world with some of the top financial education companies teaching options trading. And one of the things that I was consistently hearing was, geez, we just want to follow along with what somebody else is doing. And that was the same thing that some of my original clients, I still to this day have some of the clients that were with me when I started my financial advisory firm in the mid-90s. So I think that tells an awful lot. But when people want, they want to follow along with people that are doing this. And so we created Option Axiom, and this is how we got to the point of where we are today. So continuing on and getting into the important stuff, we are going to talk about basic options. And I know that many of you are probably very astute in trading options, and you're thinking he's going to tell me about a long call and a long put. Well, yeah, I am, but please just bear with me. I'm setting the stage here. Get to the TV yet. Stay focused with me here, and it's going somewhere, I promise. Just let me bring this together for those that may not be as versed in options as some others. So when we're talking about a long call, one of the things that we know is the beauty of a long call is you have unlimited potential profit while having a very limited amount of fixed risk. So you know what you can lose going in. If things go wrong, that's the most you can lose, but you have the potential to make an unlimited amount of profit. When we look at the other side of the coin, on the long puts, that gives us the opportunity to make money to the downside. With a put, we can make money, market goes down. I sometimes hear people incorrectly say, well, you have unlimited profit to the downside. Well, not really, because a stock can only go to 0, right? There's that really solid sub-level there at 40. We can't go below that. So I like to use the word substantial. You can make a substantial amount of profit if the stock goes to the downside, but it's not unlimited. But we still do have the limited amount of potential risk. So limited amount of risk, unlimited amount of potential profit, or substantial amount if you want to be absolutely correct on the situation. So there's our long put risk graph and the long call risk graph. If we're to put those two together, let's take a look at something known as a risk graph. Many of you may be very familiar with risk graphs. If not, it's these two axes. We have the vertical axis, which is the profit loss with a 0 or dotted line in the middle, and then we have the horizontal axis down at the bottom, which is the stock price. We can go from the bottom left corner being 0 to the far right being hypothetically infinity, or the way most people use risk graphs is for a snapshot right around the area of the potential trade where the stock is trading. So with that in mind, we look at this risk graph and we place the strategy on the risk graph. There's our long call with a risk and unlimited potential gain. So we're going to add in now the long put with a substantial potential profit and still a limited amount of risk. Putting those two together, and that brings us to the risk graph, a straddle. Now you might be thinking, wait a minute, straddles? I thought you talked about strangles. Well, we are. We're going to go from straddles to strangles and then into this twist on a strangle. And that's going to tie everything together. So there's the basic risk graph of a straddle. Now the unique thing of it is you can see the green lines is you can generate a gain if the stock moves up. You can generate a gain if the stock moves down. Where's the risk? Where's the red part? Where's the V of the risk graph that's below the 0 or break-even line? It represents if the stock doesn't move. Remember, the horizontal axis is if the stock is staying stagnant. So if the stock doesn't move, that's where your risk is. All we need the stock to do is move. Move to the upside or move to the downside. However, this is where that time key comes in. The sooner it moves, the better. Risk graphs have to be drawn at a finite period of time. So the main risk graph with the green and red lines are drawn at expiration. So the risk would be if the stock didn't move all the way to expiration. So all that time and it doesn't move, yeah, there's going to be some risk. However, that U-shaped timeline with the dotted lines represents the initial day you put the strategy on, meaning that if it does break up right away or breaks down right away, you make money right away. So the key is timing. The sooner the stock moves, the better. And again, I'm going to cover some more along those concepts here in a minute. I've got several screens here, and I'm going to try to stay away from the questions till towards the end because I get a little distracted and I want to make sure that I'm going through this. But I saw a comment there on delta, and you're going to lead me into the key part of this presentation. So I'm glad you're familiar with delta, because when I talk about delta, that's, if you're familiar with delta, then this presentation is going to really interest you. It can't not. Here's delta. So as I mentioned, you're leading me right into this. What is delta? Delta, by definition, is the amount an option's value will change as a percentage of the stock move. In general, it basically tells you how much an option is going to make versus the movement of the stock. But the key is on the very next dollar of the stock, and that's very key because that goes to the crux of the presentation. Delta is how much your option will make or lose on the very next dollar the stock moves. Once the stock moves $1, you have a new delta. And that is the whole part of the presentation that makes this strategy kind of unique, because the delta changes, and the faster the delta changes, the better. So in an example of delta, let's say we have a stock price trading at 20 and we go buy a $2 option. That's an at-the-money option, right? So we're buying a $2 at-the-money call option. Let's use calls as our example. Stock's trading at 20, we buy a $2 at-the-money call. Stock moves up to 21. As the stock moves up to 21, the option's going to make roughly 50 cents because at-the-money options have about a 50 delta. It could be a percentage to higher or lower, but at-the-money options have roughly a 50 delta, meaning they're going to make 50% of the next dollar the stock moves. So the stock moved up $1, the option moved to $2.50. Question becomes, on that $1 move of the stock, how much did the option receive? 25% or 50%? And that becomes key. Now, we only had a 5% move in the stock, right? The stock moved from 20 to 21. A $1 move in a $20 stock is a 5% move in the stock. In the option moved from 2 to 250. A 50-cent move in a $2 option is a 25% move. But delta is the relationship of how much did the option make or lose in relation to the next dollar movement in the stock. So the option moved 50 cents, the stock moved $1. So the answer to the question from a delta standpoint would be 50%. That's the key, and that's where it comes from, 50% on the delta. Now, everybody learns different. You've seen all the different auditory learners and all that kind of stuff, and maybe you've even had a test sometime in your life of how you learn. I'm a visual learner. I can read stuff and read it over and over and over again, and I'll have to read it 20 times before it sinks into my thick head. But if I can see a picture of it, I can learn much faster. When we take delta, and you can get out on the internet and look up the mathematical formula of delta. I went through calculus in college, but I can't understand the formula for delta looking at it from, you know, all the symbols and things that they use in mathematical formulas. But if we take that and we put it in a visual picture form, there it is. That's the visual picture of delta. That's the delta curve. So we start down at the bottom left side with 0. We move up to the upper right, which is 1 or 100, a 100 delta. So that's the curve. And note that it's not from one point to another in a 45-degree angle. There's an actual curve in here, and that becomes key as well. So if we're looking at the money options at a 50% delta or a 50 delta, just depending on how you want to view it or use your terminology, that's going to be right smack in the middle of the delta curve. So at the money options are right in the middle. If we were to buy a straddle where we're buying the at the money call and the at the money put, one of the options, now this is not depicting a stock moving up or down. this is depicting the option moving in the money or out of the money. If we move above that little hash mark, that's moving in the money. If we move a little bit below that hash mark, that's moving out of the money. So if the stock moves, one of the options is going to be moving in the money. So if the stock breaks to the upside, the call is going to be moving in the money. If the stock breaks to the downside, the put's going to be moving in the money. But one of the options is going to be moving in the money, and one of the options is going to be moving out of the money. But if you look at those two green arrows, aren't they pretty symmetrical as far as the angle of the movement? Meaning that the arrow moving down is showing that one of the options is losing value at about the same speed as that other arrow is depicting the option moving into money, making money. So one option is losing money at about the same speed the other option is making money. Hence the problem with a traditional straddle. Usually it requires a larger move before you start to realize a decent gain, and people just get tired of it. And then if the stock doesn't make that significant move, then you can have a significant loss because you're buying the at-the-money call and put, which are all extrinsic value, right? There's no intrinsic value in either one. So all of that money is subject to risk. But take a look at this curve and look down at the bottom left where that green little line is and the arrow that it's shading right now and creating that bubble. Call that the profit sweet spot. And when you look at the visualization, now bear with me here and visualize down at the bottom that horizontal line of a risk graph that has the stock price. And note that right about where that green shading oval area is there, note that the delta curve goes up almost vertically from that point, meaning that the delta is going almost straight up, almost vertical on very little movement out of the stock, right? So if you're picturing that horizontal line of the risk graph representing the stock price, there's very little movement out of the stock, and the delta curve is going vertical, meaning one of those options is moving up extremely fast. That profit sweet spot is right around a 30 delta. So the range we use in the strategy, because we're starting to get to the twist on a basic strangle here, is 25 to 35 delta. So we're framing, if you will, that 30 delta, which is right around the point of that delta curve just before it goes vertical. Now, if you started by buying both the call and the put at that 30 delta, and then the stock moves, one of those options is going to be moving up the delta curve almost vertically. The other option is going to be moving down the delta curve, but notice how much flatter that movement is. It's nowhere near as vertical as the arrow moving up. So if you look at this from a visual standpoint, wouldn't that imply that if the stock breaks here, one of those options, the option that's moving in the money, the vertical movement up, is making money much faster than the other option is losing money, which is far better than the depiction of one making money and one losing money at about the same speed. Wouldn't you agree? So at least in theory, when you look at this, one of these options should be making money a lot faster than the other one's losing money, which means we should be profiting a lot faster than a traditional straddle. You know how they say you do your best thinking in the shower? I always say that at seminars, and I get the blankest looks. I know I heard that expression somewhere. I can't remember where, but apparently not many people have, because everybody looks at me with a funny look when I say that. But I was literally in the shower one day thinking about this. This is how weird you get when you're an options trader. You're thinking about options trading even when you're in the shower. And I was thinking about, well, what if we take the strangle concept? Because remember, a strangle is buying an out-of-the-money call and an out-of-the-money put. A straddle is buying an at-the-money call and an at-the-money put, but a strangle is buying an out-of-the-money call and out-of-the-money put, but normally only one strike out of the money. But what if we take the concept of buying an out-of-the-money call and put, instead of just going one strike either way of at-the-money, what if we buy both the call and the put down here at that profit sweet spot, right before the risk graph on the delta curve goes vertical? in theory, it makes sense that you should be able to make money faster. Wouldn't you agree? So I was excited. I wanted to go try it. Putting this on the risk graph, there was our straddle. Here's where some questions come in. And there's the strangle. Notice what happened with the strangle. We have less risk because we took some of that bottom V part that's underneath the zero or break-even line away. So we're taking less risk, and we're taking less risk because in a straddle we're buying an out-of-the-money call and an out-of-the-money put. But then the key becomes, but the wings are wider. Now that means you need the stock to move even further before you start making money on an upside breakout or a downside breakout. And that's why very few people even look at a regular strangle. Because most people view, it's even worse. I know I'm taking less risk, but now the stock has to move further, and people don't take a look at them. But we're changing the game by we place the strangle on the delta curve. That's the key, moving it on the delta curve. So I mentioned to you that I thought about this in the shower. The theory made sense. I did back testing on it. It worked really well in back testing. So now I'm ready to put real money in it. This is an example of Google. And if you're really looking at it, you can see that the date is 2008. And you might be thinking, why are you showing us an example from 2008? All the examples I'm going to show you were alerts that we actually sent out to our subscribers, except this one. The reason I show this one, and I will always put this in my presentation, one, because it's a good depiction of the strategy, but number two, it was the first position that I ever put real money in. This was my first real money trade on this theory or strategy that I had come in. So we look at this chart of Google. It had a nice upward move and then moved into a beautiful symmetrical triangle. And right at the point, that last bar on the symmetrical triangle is a doji. So what does a doji represent? Indecision, right? Quite often a change of direction. Well, we've been moving sideways and consolidating, so we haven't really been directional. But the indecision means that maybe we're about ready to break out. So if you were looking at Google trading at $680 a share, and you were to buy a traditional straddle, which would be buying the 680 call and the 680 put, it's going to cost you $70.45. That's over $7,000 for one straddle contract. Hence another issue with straddles. They're expensive. And if it doesn't break out, then you've got an awful lot of money at risk. Not very attractive to most traders. However, if we were to design Strangel the way I described it, by buying both the call and the put at as close to the 30 delta as we can, look what we do to the cost. $26, $2,600. So we're paying $2,600 for the Axiom Strangel that I'm describing to you versus over $7,000 for traditional straddle. Now look at the strike prices. By looking for the 30 delta call, that would be a 750 strike call. Remember, Google's trading at 680, so that's 70 points higher. Going down the put side and looking for the 30 delta put, so it would be represented as a minus 30, right? So if we have a positive 30 delta call and a minus 30 delta put, that gives us a net delta of 0, hence the term delta neutral. And that just simply means we're not picking a direction. Delta neutral is non-directional. We're not picking a direction. So if we take a look at this, you might be thinking, wait a minute, if Google's at 680, the call's 70 points higher, but the put's only 50 points lower. They're not symmetrical. No, they're not, nor do we care if they're symmetrical. We don't care what strikes they are. They don't have to be even. They don't have to be equidistant from where the stock's trading anymore, like a traditional strangle. All we want is to go down the options chain. Where's the 30 delta call? Boom, that's the one we want. Where's the 30 delta put? Boom, that's the one we want. Doesn't matter what the strikes are. We're matching up the deltas, not the strikes, if that makes sense. So $2,600, but there's 120 points between the 750 call and 630 put. And an average person, because I know I've heard it so many times, would say, you got to be crazy. Google can move a lot, but it's not going to move 120 points. It doesn't have to. There's no rule that says one of these options has to move in the money before a strategy will become profitable. All we need is a net gain between what one option's making and one's losing. It doesn't have to move in the money. So the fact that there are 120 parts is completely immaterial. So Google breaks to the downside. First day, nice breakout. You look at the straddle that you paid $7,000 for, makes $495. And you're thinking, wow, that's pretty good. I'm happy. But looking at the strangle, the way I described it, changing where the strikes are on the delta curve, we made $590. We only paid $2,600 and we paid $590. We paid over $7,000 for the straddle and we only made $495. Isn't that amazing? We paid significantly less and made more in real dollars on one contract. I don't know about you, but that sounds like a win-win to me. Pay less, make more. I'm pretty excited. Next day, Google breaks down again. Well, you would be thinking, all right, stock's moving down. The put option is obviously the one in control. That's the one moving up the delta curve. Google moved down again. We should have made more money. But look what happened in the straddle. We're only up $390 now. We gave back $105 of profit. Why? What happened? Well, if you know anything about implied volatility, you know what happened. Google moved $28 down the first day. It only moved down $8 the second day. Was it as volatile the second day? Obviously not. So based on the drop in implied volatility, even though the put option gained more value, the volatility crush, if you will, took a lot of that away, gave back $105 of profit. Well, let's take a look at the strangle. The strangle made $15 more. We made $15. Now, that's not a big deal, making $15, but it's a whole lot better than losing 105, isn't it? Why? Why did the straddle lose money and the strangle was able to eke out a little bit of a gain? Because a volatility crush is not affected nearly as much on out-of-the-money options as it is at-the-money options. At-the-money options have the greatest susceptibility, if you will, to a volatility crush. Out-of-the-money options doesn't hurt them as bad. In fact, we were able to eke out a gain based on the delta versus the volatility crush. Google breaks down again. Straddle's now up $885. That's pretty good. But look at the strangle. The strangle, the way I described it to you, moving the options to that profit sweet spot on the delta curve, $1,090. We paid over $7,000 to make $885 on the straddle. We only paid $2,600 and made over $1,000 on the strangle. Now, the straddle, that's a 12.5% return. You might be thinking, hey, that's not bad. It's not bad that quick. But in the strangle, we made 41.9%. Which would you rather have? 12.5% or 41.9%? It's more money in profit on less money at risk. I think everybody would agree that is a great thing to do in the world of trading. Limit our risk and capitalize on our gains. The benefits to strangles, especially this way, they have less cost and therefore risk, because as you know, a debit trade, whatever the debit is or the cost, is your risk. Faster profits. Why? Because of the acceleration of delta. Now, those of you that are familiar with delta, you probably know gamma too. Gamma is how fast the delta moves. That's really what we're focusing on here. Remember, delta is only how much an option will make or lose on the next dollar the stock moves. After that, there's a new delta. New delta is determined by the gamma. Gamma is how fast the delta moves. That's what we're focusing on here. We are creating a scenario where the delta accelerates faster. The gamma is better. And that's how this works. Now, what kind of patterns work with this? What kind of stock patterns are we looking for? Well, there's three primary ones. First one is what's known as an ascending wedge or ascending triangle. You can see where the stock has a price level high, goes up, hits that level high, comes back down. But when it comes down, it makes a higher low. Then it goes back up, bumps its head up against that resistance point again, fell back down, came back up, right back up to the resistance underneath there. Which way do you think this is going to break? Most people feel that an ascending wedge or an ascending triangle is going to break to the upside. That you're building pressure up underneath this resistance point, and then it's going to break to the upside. It's finally going to force its way through that area of resistance, right? Because when you're bumping your head, you're hitting resistance. Statistics don't show that, though. Statistics show that the stock is just likely to break to the downside as it is to the upside. But it's not what a lot of people say. Now we have another pattern, a descending wedge pattern. The stock moves from a high down to the low, bounces back up. This time it makes a lower high. Then it comes back down. It's the same low, bounces up, makes another lower high, comes back down to that same low again. So now we have a series of lower highs, but the same lows. What's that known as? It's known as a descending wedge or a descending triangle. Most people feel this is going to break to the downside, that you're building enough pressure here that you're going to force your way through that support line. Statistics don't show that, though. Again, statistics show you're just as likely to break to the upside as you are the downside. It doesn't matter, and we don't care which way it goes. We just need it to move. Last one is what's known as a symmetrical wedge or symmetrical triangle, where the stock moves up, hits a high, comes back down, makes a higher low, moves back up, makes a lower high, comes back down, makes another higher low. So you're building a series of lower highs and higher lows. A symmetrical wedge or symmetrical triangle. This one, you know, is going to break either direction. There isn't really any sort of information out there saying that one's going to break more one direction than the other. This one clearly is going to break either direction. Symmetrical wedge or symmetrical triangle. Now, if I had to pick a favorite, and you're only allowed, they all three work, but if I had to pick one, it would be the symmetrical wedge or symmetrical triangle. Now, there's other breakout patterns. There are flag patterns and there are pennant patterns. Those also yield breakouts. It's been my experience, however, that the wedges or triangles work better. So I stay focused on those. I don't care which one of these three it is, but I stay focused on these. Now, other people may feel differently. Other people may have had different experiences and they really like a flag or they really like a pennant. I also don't think those show up as often as the triangles or the wedges do. There's always stocks in wedge or triangle patterns, always. So those are the three basic patterns that we look for. Here's another example, and this is a really good example of what happens quite often as well. Google broke out immediately, and that's fantastic. They don't all break out immediately. So when we look at this pre-research here, now we have our nice symmetrical triangle. There's the point right in the middle, and we set this up with a regular straddle. Stock's trading at 60, so that's the 60 strike call, 60 strike put. This was an actual alert sent out to the subscribers. And we have a strangle. And the strangle would be the 62.5 strike call and the 57.5 strike put. Now remember, we're more focused on the delta than we are on the strike prices. But the axioms would be going even further out of the money, and it's the 55 strike put and the 65 strike call. So here's a comparison of the traditional straddle, a traditional where you just go one strike out of the money either way, Cree had 2.5-point strikes, obviously, by the example. And then the strangle that I described them with where the stock is on the delta curve, which is further out of the money, the 55 strike put, the 65 strike call, and look at the comparison of pricing. The straddle cost $8.95 per contract. This is a little more realistic, too, than the $70 to trade Google. The strangle, we bring the price down to $6.67, so quite a bit less. But in the Axiom strangle, we bring the price down to $4.82, a significant drop in price. Not quite, but almost half of what the straddle would cost. So we're paying just roughly around half. Let's just roll it a little bit. Say we're paying half for the strangle than we are for the straddle. But again, you might be thinking there's absolutely no way that this is going to make more. Now, if you want to know whether or not we deltas, look, the delta is 5 is the net on the straddle, 5 is the net on the strangle, it's 6 on the strangle, and the stock breaks to the downside. So if anything, the delta net was slightly worse in the Axiom strangle. So there's no help there. In fact, it was a little bit worse. So this is a really good example of how well this works. It breaks to the downside. The straddle is $118. The strangle is up $117, which is interesting, isn't it? Even the traditional strangle is reflecting the speed of the movement of the delta. The Axiom strangle generates $101.00, so not quite as much profit as the straddle or strangle, but remember we paid roughly half of what we paid for the straddle. What could you do if you're paying half? Couldn't you do twice as many contracts? You could do twice as many. If you're only paying half of the amount, if you have a targeted amount of risk that you're putting in a particular position, so you do 2 of them. Now you're making a whole lot more than you would have made in the straddle. Well, then look what happened. Now, Google was nice, wasn't it? It broke straight down. And quite often they do that. Quite often the breakout, when they create these triangles or wedges, quite often it is a vertical move, but not always. There's different things that occur. I'm going to give you a couple examples right now because, again, I want to be very open and transparent about this. In Cree, it broke down and it came back up to test the breakout. So it came back up and it tested the breakout. On the test of the breakout, from that point, we are probably not doing so well, right? Because time is going by and time decays the enemy. So the straddle's at a $200 loss at this point. Straddle is at a $204 loss at this point, and the Axiom strangle, $188 loss. None of the positions are looking too good with the fact that the stock is going sideways for a while due to the fact that we broke down, consolidated, and came back up to test the breakout. But once the breakout was tested, then look what happened. Boom! Big move to the downside. The straddle, all of a sudden, is profitable. Barely, but profitable. So the loss is wiped out. The strangle, we're basically back to even. The Axiom strangle, just a tiny bit of a loss, but a whole lot better than where we were a day ago. Stock breaks down the next day. Straddle is now profitable by $127. The strangle is profitable by $108. And the Axiom strangle has now a profit of $61. So if you did 2 of them, then you'd be basically about the same amount of gain as the straddle. But we're not finished. Cree breaks down some more. Finally starting to do what it was supposed to do in the beginning. Breaks down further. The straddle, $294 profit. The strangle, $285 profit. The Axiom strangle, $241.50. We're catching up quickly. Another down day for Cree. The straddle's now at a $434.50 gain. The strangle is at a $411.50 gain. So you paid less and made roughly the same amount in the strangle. But with the Axiom strangle, you about half and made almost the same amount at $365. The straddle generated a 45.5% gain. And again, you're probably thinking, that's not bad, I'd take that. The strangle, 61.6% gain. However, the Axiom strangle's profit, 75.7%. So which one would you rather have? 45, 61, or 75? It's really your choice, because you can place any one of these three positions on every one of these cards that shows up. It's your choice. Now, another question that comes up is, well, when the stock breaks out, why don't you take the other option off? In other words, if it breaks to the downside, why don't you take the call option off? Well, here's an example of why, and this happened at a seminar that I did in Orlando, Florida. A gentleman came up to me, and he traded straddles the regular way, and he traded them the way a lot of people do, which doesn't really work too well, in front of earnings. And I'll explain why that doesn't work so well in a few minutes. But he had his straddle on a drug company stock. This drug company had a new, highly anticipated drug under review. They were expecting big things from it, so he had a straddle on it. 2 days before the expected announcement, I don't think anybody really knows when an FDA announcement is going to come out, but 2 days before the expected announcement, stock breaks to the upside. What is he thinking? Aha, somebody knows something, right? But we know no information ever leaks out, right? That never happens. But he's thinking somebody knows something. He takes off his puts and loads up on the calls. So what do you think the FDA said on the announcement? Nope, they didn't approve the drug. The drug tanked. He lost almost his entire account on one trade because he took one of the legs off. Sometimes these patterns have a false breakout. You'll only get one false breakout. So if we get a breakout and the stock moves, let's say it moves down, and then it comes back up, it may test the breakout like Cree did, or that might have been a head fake and the actual move is to the upside. So you get a breakout to the downside, and then the big move, the full-fledged move, is to the upside. And we know with amazing accuracy about how far these are going to break out. It goes to the width of the triangle. And I can go through those numbers with you. 75% of the time, the stock's going to break the same amount of price range from the height of the low in the mouth of the triangle. That's the wide part. 90% of the time, it's going to break 80% of that amount. And I know it sounds like a lot of numbers, but let's say from the high to the low represents 10 points. Let's say the low was at 80 and the high was at 90. Okay? Well, 75% of the time when the stock breaks out, it's going to break 10 points. And then it's like, boom, hitting a wall. It's incredible how it just stops when it hits that point. But 90% of the time, it would break 80% of the mouth, or 8 points. And then in that last, even if it goes the full breakout, the full 100% breakout, usually those last few days are much smaller movements, and volatility comes out. You really don't make anything more if you wait. So we tend to focus on the 80% breakout. Sometimes you make even more on that, even if it breaks 100%, if it really slows down in the movement because of the loss of volatility. When these things break, they break so violently that volatility spikes quite often. So be very, very careful about taking one of the legs off, because you can get that false breakout, and it will head fake you. You think it's breaking out, and so you're like, oh, I'm taking the calls off. I'm just going to ride these puts down. And then the stock reverses, and the big breakout's to the upside. Your puts go to zero. You have no calls. You're at a full loss, or a good part of the loss, because you probably got something back when you took the calls off. Now, let's say the stock breaks to the downside. It gives a false breakout, and then it breaks back to the upside, and then it comes back down. And you're thinking, well, there's two false breakouts. There's no such thing as two false breakouts. What that pattern is doing is creating a larger wedge or a larger triangle. And when it creates a larger wedge or a larger triangle, it's going to take more time to break out. Now, there are times, we love it when they break out right away, but again, I'm trying to be really open and honest with you on how this works. There are times when we use indicators that give us an uncanny look of when a stock is really ready to break, but nothing works 100% of the time. Sometimes the triangle pattern becomes larger, which in the long run is going to be good. The bigger the pattern, the more the breakout is. But then it requires patience, because the first pattern could go to zero if it doesn't break out within that original time frame, and we put these on 45 to 60 days. And the reason we do that, It's because we're taking advantage of that delta and gamma. You might be thinking, well, I know the 45 days, because you put it on less than that, you're way too susceptible to time decay. But why don't you go past 60 days? Why don't you put it on 120 days? Then you don't have to worry about how long it takes to break out. Yeah, but if you go that far out in time, gamma goes way down. Now you just shot yourself in the foot and you nullified the entire strategy. We need that big, huge move in the delta. That's what we're looking for. So let's say that for the first month, it goes to 0. It doesn't break out. The strangle's worthless. We're going to put another strangle on and give it another 45 to 60 days to move. Because they're going to break out. These patterns, they break out unbelievably often. But do they break out right away? A lot of times they do, but not every time. And people get frustrated. And they're like, it went to 0. Why do we let it go to 0? And you put the pattern further out, and you hear comments of, you're just rolling it out, whatever. Why? Because it's going to break. And why are we going to abandon it? And time after time after time, you can see the results on the website. It might break. It might take that second time frame. And then it breaks. And then the break is so significant that you recover the loss from the original position and the amount that you paid on the second one. You at least get your money back, and quite often a gain. Now these things are going to make 40 to 60% on average. Sometimes you get lucky and you hit a home run, but those are rare. And if it takes an extra time period, if we have to roll it out and wait, well, then the profit may drop down to about 20%. But it's a whole lot better than taking a loss, a full loss, or a 50% loss, or whatever you focus on along those lines. So there are times when it requires patience. And one thing that I've learned is not everybody has that kind of patience. But these things are going to break out. Now, luckily, those are rare circumstances. Usually they break in the time frame. We just had a good one on SINA. Take a look at the chart of SINA, SINA. You'll see the breakdown. There's several of them that are currently working right now. So I just wanted to try to explain things to you so everybody had a great understanding of what we're doing moving in. It works. They're going to move. They're going to create their own volatility. We don't need the market's volatility. We're not going to turn it down, but we don't have to have it. Now that period in December 2013, that was an aberration. The market had no volatility. So then it took into January to come back and recover the losses, and that's what I'm talking about. Sometimes it takes a little bit of time. But this is an amazing strategy in general. I think you would agree. And we have a scan that identifies not only the triangle patterns, but that tells us when we should get in, when it's about to break out on the norm. And again, there's always exceptions, but on the norm. Now take a look at, here's Baidu. This is why it's not a good idea to do these right in front of earnings, which what some people do still to this day with straddles. We had our strangle scan identified this position on this day. So you can see we have a bit of a ascending triangle, quasi-symmetrical triangle, but certainly lower highs and higher lows. So looking at this, if we buy the 99 strike call and the 78 strike put on Baidu, it's going to cost $7.33. Look at that breakout. Love it when they do that. Wish everyone would do that. Do they all? No. But that happens enough to make it an awful lot of fun. Boom. Straight vertical breakout. Perfect. Couldn't have scripted it any better. So that strangle, the Axiom strangle, the 99 strike call, the 78 strike put, again looking for the positive 30 delta call and the negative delta put, makes $737 on the breakout, which is just a hair over 100% gain. So I said that we get those sometimes. Doesn't happen all the time, but we get them enough to make it, again, an awful lot of fun to do this. Now watch what happens with Baidu. After that breakout, it consolidates again, and it goes into a symmetrical triangle right for earnings. And you might be thinking, this is perfect. I'm going to double dip on this one. I'm doing it again. I'm going to put another one on. Well, our scan didn't identify it here, and there's a specific reason why. But if you just looked at the chart pattern, you could see, wow, this is ideal. a symmetrical triangle consolidation pattern on Baidu right before earnings. If you were going to put that position on, it would be the 115 strike call, the 96 strike put. It would have cost you $10.40. Why did this one cost so much more than the one we actually did and sent out as an alert? Well, the reason is volatility. Hopefully you said that. We're right before earnings. What do they do? The implied volatility on the options of a stock that's right before earnings, especially a stock where it normally moves on earnings. Look what happened. Boom, it breaks out on the earnings report. Nice move higher. In fact, the chart's running out there at the top, but the price level move ended up being more on the breakout following earnings than it was on the one that we traded. Look what happens to the position. It loses money. It's a $251 loss. Why? Why is it? How is that possible that the stock moves $1 or $2 more price-wise than the one we made 100% on, but that one loses money? Because implied volatility is ultra important in the world of trading options. I'm sure you're aware of that. There's the volatility chart. Baidu. Take a look. When we entered our position, the implied volatility was down at the bottom, extremely low. Options were cheap. The stock breaks to the upside. What happens to the volatility? It goes up for two reasons. One, because of the extreme vertical nature of the breakout, that increases the volatility, and we have an earnings report coming up. That increases the volatility. That's why we got 100% out of that one, because not only did we have the movement of the delta, the great acceleration, the gist of the strategy, but we had an aid from implied volatility. We don't always get that much. The fact that it was going into earnings was helpful. But look where the volatility was if you would have placed the second one, which again we did not do. It didn't follow our rules. But had you placed it, you would have been putting that strangle on at the absolute peak in volatility. And then what happens to implied volatility? As soon as an earnings report's announced, boom, they crush it. The implied volatility crush. And that's significant. And that's why the first trade made 100%, the second trade lost 24% on roughly the exact same movement out of the stock. Pretty amazing. Better pay attention to implied volatility in the world of trading options. Again, the Axiom strangle, less cost, therefore less risk. The risk is the debit. If we have a lower debit, we have less risk. We generate profits faster because of the acceleration of the delta. The key. Spend less, make more. It's just a twist. It's taking advantage of the math, and the math is finite. It's part of the way option pricing is calculated. So we're taking that and we're putting it in our favor. Volatility risk, time decay, those things are working against us when we buy at the money options. It's something that we know going in that we're fighting. So what are we doing? We are taking what is those negatives and we're actually putting them in our favor by simply repositioning the trade on the delta curve. In general, that's what we're doing. We're repositioning the trade on the delta curve. Our scan finds those patterns. It'll find the ascending, symmetrical, and descending wedge patterns. It'll also find stocks that are channeling or going sideways too, because they have the same Greeks and readings that come out. So you just stay away from those. We obviously don't want a stock that's in a sideways channel or anything along those lines, because that could stay sideways for a long time. We stay away from those. But it finds all three of the wedge patterns. Normally we can find them earlier, before the breakout, and our indicators, quite often, you saw some of those results, give them to us before they break out. We are only going to buy them when implied volatility is low. That is a given. That's part of the rules. And we generate these explosive moves where you get these vertical breakouts, where they generate their own volatility, and the speed of it generates profits very, very quickly. Again, I've been doing this for 7 years, and it's amazing. If you'd like to learn more, you can actually go to our website. We have a free weekly outlook where you can register, where every week I give you an outlook of what's coming for the next week. And if you're interested in this strategy, If you'd like to know more about the strategy, we do have an offer here for you. We have the absolute lowest price. Don't go to our website if you're interested in subscribing to we send out an alert. I send it out through text messages or through email or both, if that's your preference. Anytime one's identified, we send out the alert to our subscribers. Don't go to the website to subscribe. Copy and click this link. You just saw the link in the chat box there as well, because there is a significant discount for you through the trading pub. And you'll definitely want to take advantage of the discount. I firmly believe that when we look back at the end of 2015, we are going to see that it is a far more volatile year. Volatility is coming back. The VIX has been low for a very long period of time, and yet we've still been able to do extremely well with this strategy. If we get the market in a more volatile scenario, we're going to do even that much better. And I think that's amazing and very exciting. So we'd love to have you come along with us and enjoy. Let's make some money together in 2015. So again, if you're interested, you can click on that link. I've used up my time. If I could look here and see, maybe I can grab one or two questions. How far out? It looks like you guys were answering a lot of the questions I was asking as you're going, and you're doing really well. So you're obviously a knowledgeable group. Question of how far out, and I want to reiterate that because it's very important. 45 to 60 days is extremely important. Less than 45 days, time decay is working too much against you. Even if it breaks out, you're not going to generate as much of a gain because of the fact that, unless it moved within 2 or 3 days, and that happens, but you can't count on that. And we don't want to go past the 60 days. I would rather take a loss in the first position and move it out again for another time frame and take advantage of the move than I would to go out past 60 days. Because if you compare the two, and I've done plenty of back testing on this, if you compare the two, you're still going to come out net better by having one position, lose, and go to the next one, and then get the breakout, recover the initial loss, make a 20% gain, versus buying the options 120 days out and have it move. You can actually have the breakout occur. I've done this in back testing and still lose money. It's crazy and it makes no sense. Been doing it for a long time, got the bugs worked out. I know the ins and outs, and I think it's a unique strategy. It works in all market conditions, which is also a great thing. Now, in 2008, you get a move in 2008 when you've got the VIX up at 90, we're probably not going to send out any alerts because options are too expensive. That's an extreme, and I'm kind of making a joke about that, but literally it doesn't matter if the market's moving up, down, or sideways. Another question, if you put them how far before earnings, I don't want to make it sound like you never want to do it before earnings, but you don't want to do it like Baidu, where you're putting it on just in front of the earnings report because implied volatility is too high. So you want to be 10 days to 2 weeks out before an earnings report. If you've got a pattern, if you've got a symmetrical pattern, and then you've got 2 weeks till an earnings report, that's ideal. Because we all know earnings reports move stocks. That's why they pump up the volatility in the options going into the earnings report. So if you can find a nice triangle with 2 weeks before earnings, that's a good one to do. Now remember, you pay attention to volatility, make sure the deltas match up. We like to try to keep the deltas, if we can, in the +5 to -5 net. We don't want to go too far outside of that range. You saw we did one with a 6 delta. That's about as far as we're going to go on these, because you don't want to become too directional. Because with Murphy's Law, what's going to happen? It's going to break the opposite direction, right? So we want to stay as close to delta neutral as we can. Thank you for your attention. Promise not to take you away too much from the basketball. I want to thank Raleigh for having me, and hopefully you found that really interesting. Again, if you'd like to know more, click on that link and you can find out more information about it. The IV that is showed, there's a really good question. Let me cover this real quick. The IV is on the options. Okay, obviously, if we're dealing with a stock that has better historical volatility, meaning you've got a stock that moves, we love to do those, but then you have to be even more careful that the implied volatility is low. So when I showed you that chart of implied volatility, that was on the options, not on the stock. So great question. Thanks for your comments. Appreciate it very much.
All right,
No,
folks.
they
Well,
haven't shown
thank
it.
you, Rob, for that terrific presentation on how you use
Hey,
your
hey,
unique Axiom Strangle to trade the options. You know, I know that many of us in the room here really appreciated your clear explanation of what a delta is. I know I certainly benefited from that. And then I love the way you took us through the difference between a straddle and a strangle, and then ultimately the Axiom strangle. And I also want to thank you for that special offer that you put together, you know, for our members here. And I hope everyone here takes advantage of that special offer that Rob is extending. So, you know, Rob, if you're still with us, if there's some few more questions here we'd like to address, let's go ahead and pluck those off.
Okay, there was one question. I typed it in the chat box, but I thought it was a really good question. How many trades are on? We usually have 6 to 8 alerts that are out at any one time. We put approximately $500 at risk per position. Obviously, depending on your account size, you can vary that and put as much risk or as little as you want based on your own individual risk management and your own portfolio management. But that's how, when we send out the alerts, they're based on approximately $500 of risk per alert that's sent out. And there's usually 6 to 8 on at any one time. And that doesn't necessarily mean, I mean, there could be 10 or 12 per month that occur. It just all depends on how fast they break out. But we do want to be sensitive on how many that we have at any one point in time. That was a really good question. Look and see if there's...
Okay, any more questions while we've got Rob here? I do want to point out to everyone that this session has been recorded, and folks, we'll have that rendered and edited, and we'll send it out to everyone that has registered today via email no later than tomorrow afternoon. So tomorrow afternoon, look for an email from the Trading Pub, and we'll include a wrap-up of this presentation as well as a link to the recording. So for those of you that may have come in a little bit late, or once again just want to see the presentation one more time to take full advantage of all the great information that Rob has shared, you'll be able to get that by looking at the video tomorrow afternoon. And we will also include a link in that email to the special offer that Rob has extended to everyone here in the room. So that's how we'll work with that. So it looks like, Rob, at this point in time, all the questions have filtered in. I'd like to thank you once again for the time that you took to prepare and to share your presentation with us today.